All right, let's get right into it. Today, we're digging into something that sounds incredibly boring, currency swap lines, but is actually a trap being laid for some of the world's fastest growing economies. It's a story that kicks off with some official-sounding press releases, but trust me, it ends with a direct threat to your emerging market investments. So, let's unpack this.
This right here is the whole thesis, and it's a serious warning. By the time we're done, you're going to see exactly how the U.S. Treasury is turning a tool that was meant for stability into a weapon. A weapon that creates what we're calling a liquidity vacuum, and it puts any gains you're hoping for in emerging markets for 2026 squarely at risk.
So where do we start? Well, you have to begin with the official story, right? The narrative that's being sold to the public is all about strength and stability, the U.S. acting as the world's financial big brother. But we're about to peel that back and show you the much more dangerous reality hiding just underneath.
Now, when you see a headline like this, your first thought is probably, oh, that's good. It sounds like the U.S. is stepping up, being the lender of last resort, and giving its friends a safety net. It's totally framed as a sign of confidence. But here's the brutal truth. You only need a safety net when you're walking a tightrope hundreds of feet in the air. The fact that these lines are even being opened tells a very different and much more worrying story.
To really get what's happening, we've got to look under the hood at the global financial plumbing. Because far away from the headlines, there's this frantic, almost desperate scramble for US dollars going on. And this is not just normal market buzz. This is a system that is clearly under some serious stress.
Okay, this term, cross-currency basis swap, looks super intimidating. I get it. But the concept is actually pretty simple, and it is the key to this whole thing. Think of it as the price to rent US dollars if you're in another country. So let's say a bank in Tokyo needs dollars. It can swap its yen for dollars for a little while. Normally, the price for this rental, the basis, is basically zero. But when there's a dollar shortage, that price goes crazy. A negative basis means that bank in Tokyo is so desperate for dollars, it's willing to pay a huge premium just to borrow them. It's basically surge pricing for the world's money. This is the single best indicator. It's the market's fire alarm for a global dollar shortage.
And that fire alarm, oh, it is screaming. In March of 2026, the total amount tied up in these swaps, the notional volume, hit an absolutely staggering all-time record of $1.56 trillion in 1 month. This isn't a small tremor, people. This is a financial earthquake. This number is proof positive that the world's biggest financial players are scrambling for dollar funding on a scale we have literally never seen before.
And this chart just brilliantly shows where that pressure is building. We're not talking about small developing countries here. Look at the top of the list, Japan and Europe. The massive volumes coming out of Tokyo and London show this huge shift by major institutions to lock down their dollar buffers. And here is the crucial part. When these financial giants are sucking up every available dollar in the market, it creates this devastating vacuum for everybody else. They get the dollars first, leaving emerging markets absolutely starved for the liquidity they need to just function.
So, with the entire world scrambling for dollars, you'd think the U.S. Federal Reserve would just step in with its usual toolkit, right? Well, this time is different. This is where Treasury Secretary Scott Bessent comes in. He's not playing by the old rulebook. He is changing the game entirely. And this change is what we're calling the Bessent effect. So what's the big difference? Look at this. The Fed's tool is like an unlimited fire hose. It's automatically available to the small club of rich countries to just, fix the plumbing. Bessent, on the other hand, is using the Treasury's fund. Think of it more like a small, targeted water pistol, and it's aimed only at allies chosen by the White House. This is the critical shift. Access to dollars is no longer an automatic market thing. It is a discretionary, geopolitical decision. He gets to decide who gets a lifeline and who gets left out, all based on political alignment, not what the market needs. Okay, so let's put these pieces together. On one side, you've got this frantic global scramble for dollars. On the other side, you have this new U.S. policy that turns dollar access into a political prize. The collision of these two massive forces is what creates the trap, the liquidity vacuum.
And this is the central paradox, isn't it? If the U.S. is handing out these dollar lifelines, why does it seem to be sinking the very markets that are supposed to be the engines of global growth? The answer lies in a really powerful and honestly a deeply concerning inverse correlation.
This is the one chart that tells the entire story. Just look at the relationship. March 2020, COVID crisis hits. Swap line usage explodes to $450 billion. And what happens? Emerging market stocks get absolutely crushed, down 18.5%. Now fast forward to Q1 2026. Under Bessent's new policy, swap lines hit an estimated $210 billion and EM performance plummets again. Now look at the historical average. When swap lines are quiet, EMs do just fine, up over 4%. The data it's undeniable. A spike in swap line usage is a death sentence for emerging market returns.
So here it is, the big takeaway. Just forget the official story. Swap lines are not proactive signs of stability. They are lagging indicators of a crisis that is already happening. By the time a central bank has to go public and ask for a swap line, you can bet the commercial banks in that country have already been hoarding dollars for weeks, pulling capital back from anything risky. And what's the first thing they sell? Emerging market stocks and bonds. The swap line isn't the cure, it's the tombstone.
But you might be wondering, why would a nation as rich as the UAE, sitting on $2 trillion in assets, even need a lifeline? The key word here is flows. Geopolitical problems, like the shutdown of the Strait of Hormuz, have choked off the day-to-day flow of petrodollars, the cash they get from selling oil. So they have plenty of long-term assets, but they don't have the liquid cash they need right now. And for the U.S., offering a swap line is a purely strategic move. It stops these allies from having to dump all their U.S. Treasury bonds on the market, which would cause absolute chaos for U.S. interest rates. It's a deal born out of mutual desperation.
So this new reality, it demands a completely new playbook. The old rules of global finance are breaking down, and investors really need to understand this new landscape if they want to navigate it successfully.
For decades, investors have counted on the dollar smile theory, this idea that the dollar always gets stronger in a crisis because everyone flees to safety. But that's breaking down. When U.S. protectionist policies are the source of the global risk, the dollar's safe haven status starts to erode. And for emerging markets, this is the worst of both worlds. The dollar is still expensive because of the U.S. economy, but it no longer provides that stability it once did. This fragility in the old, politically driven system is creating huge demand for an alternative. This slide kind of compares it to a parallel system that's popping up, kinetic finance. While traditional banking takes days to settle and is subject to political whims, this new on-chain system offers what the old one just can't: instant settlement, 24/7 availability, and permissionless access, which just means nobody can stop you from using it. It's a direct technological answer to the very dollar shortages and political gatekeeping we've been talking about. It's a potential escape hatch from the liquidity vacuum.
So let's bring it all home. First, the next time you see a headline about new swap lines, don't think stability, think massive red flag, especially for your EM funds. Second, thanks to the best in effect, dollar liquidity is now a weaponized political tool. Third, when the big shots in Tokyo and London scramble for dollars, the emerging markets get left high and dry. And finally, the entire investment game is shifting. It's no longer about chasing growth at any price, it's about finding liquidity at any cost.
And that leaves us with this final, critical question. In a world where liquidity is weaponized and the old safe havens are broken, are the traditional models of diversification just obsolete? If the dollar isn't the reliable anchor it once was, and the tools for stability are now just signs of distress, do we need to rethink the fundamental ways we build our portfolios? The dollar swap trap suggests the old answers just might not apply anymore.